Hi there, hope you're having a great day today. Today I want us to talk about some 4 important investment concepts that you will time and again hear people talk about in the investment world. Number 1, liquidity. Now, liquidity is nothing but the ease with which you are able to convert your security or your asset into cash. Right? So if I bought shares and I want to sell them and convert them into cash, how quick can I do that? Now we say an asset is highly liquid if I'm able to convert it into cash quickly. And when an asset takes time for you to convert it into cash, we say it's illiquid, which means it cannot be sold easily as quickly as you want it. Right? Now, an example of a highly liquid asset will be a share or cash itself, or will be your bonds. Something that is highly illiquid will be something like real estate. You need some time, you need 3 to 6 months to be able to convert your asset, which is your property, into cash. Now it is important to understand the concept of liquidity, because when you invest, you must be aware of the type of asset you invest in, so that you understand whether it is highly liquid or highly illiquid. Because come the time when you will be wanting to convert that particular asset into cash, you might get surprised only to find that you need to wait for a longer period to convert that particular asset. That is why it is important to always make sure that you invest the money that you are not going to need it tomorrow. When we invest, we must have a long-term view. And when you have a long-term view, it means you are not going to need those funds in the short term. It is important that you have that in mind. The second concept I want us to discuss is called market volatility. Now, market volatility describes a period where there's an unpredictable movement of prices in the market. And those movements can sometimes be so sharp, downwards or upwards. So the price of a share can go sharply high, or it can go sharply down. Those are volatilities. You need to understand this concept, because when you invest, you're gonna have a lot of those along the journey, along the way, as you wait on your investment to grow. And depending on your strategy, you will respond accordingly to the volatilities. If you are investing and you have a long-term view as far as your investment is concerned, you will not bother that much with the volatilities, because you know over time the market is going to correct itself. But if, for example, you speculate in the stock market, you'll want to react quickly based on the movement of the share price. But these videos that I do are not about speculating. They are about someone who invests in the long term with the aim of creating wealth. It is not about speculation. Hence, you shouldn't worry much about the volatilities, because they tend to correct each other over time. It is important that you understand this concept too. The third concept that I want us to look at is called buy and hold strategy. Now, this strategy fits well to someone who has a long-term horizon as far as their investments are concerned. If I have a long-term view when I invest, then this strategy makes sense, because it simply says you buy and then you hold, which means you buy and you don't sell. You buy and leave whatever you have invested to the market over a period of time, so that after some time you are able to get returns and to have your investment grow. This type of an investment is very passive. Hence, I spoke about speculating. When you apply buy and hold strategy, you are not speculating. You are investing for over a period of time. Your horizon is in the long term. Now, when you invest in the long term, ideally, that will be one of the key strategies that you can use to buy and hold. You buy and behold the market. You leave everything to the market because you know you cannot predict the market. You can't beat the market. All you do is you invest in your assets, and once you've invested in your assets, you wait over a period of time. Someone who uses this strategy is someone who has time in his hands. Investing is about you having time. When you don't have time in investments, you run the risk of speculating and losing money in the process. The last concept I want to discuss with you, it's called diversification. It comes from the word diverse or diversity. Now, if I were to define diversification, I would say basically it's about spreading your investments across multiple different types of assets with the intention of minimizing risk, and secondly, with the intention of increasing returns. Any person that invests because he wants to see returns, and he invests because he wants to minimize risks, so that when risks are minimized, the person realizes returns. That's what diversification is all about. Have you heard of the concept, do not put all your eggs in one basket? Yes, that's diversification. You want to spread your investments such that when one is not performing, the other one performs. And that way, these assets subsidize each other. So you do not feel the effect of the loss or the effect of no return from this particular asset, because this other one is growing or is showing or giving you returns. So diversification means minimizing risk and increasing returns. And how do you do that? You do that by spreading your investment. You invest in property, you invest in stocks, you invest in commodities, you invest in cash, you invest in different asset classes, and sometimes in different markets. So that when this market is not performing, this one is performing. So it's subsidizing the one that is not performing. So diversification is key when it comes to investment. You must make sure that your investment portfolio is highly diversified so that your exposure is minimized, the level of risk is minimized, and you are able to realize huge and high returns. I'm going to wrap it up. We spoke about volatility. Understand the concept, the movement of the price in the market. We spoke about liquidity, and understand your liquidity requirements when you consider investing in certain assets. We spoke about diversification. You need to spread your investments so that you minimize risk and ensure that you realize high returns. And lastly, we spoke about the buy and hold strategy. If you are an investor, you must have a long-term view, and therefore you need to be able to buy assets, you need to be able to invest in certain assets and leave them over a period of time so that the asset and the portfolio can grow, and then you can realize the returns. And that way you create wealth. Hope this video helped you. Thank you. Bye.